My name is Todd Anderson. I work for LendIt. LendIt is a Fintech and online lending events company. I run the content at LendIt. My official title is Content Manager and Journalist. My colleague James is here as well. He runs sponsorship with our sales team. So thanks everyone for being here. Thanks Matt and Orchard for hosting us. Before turning over to Matt and the panel on alternative investing, just wanted to tell everyone a little bit more about LendIt and LendIt China coming up, as well as LendIt Europe. LendIt China is going to be in mid-July. It's a 7-day tour followed by a 2-day conference. It's going to go to 4 cities: Macau, Hong Kong, Beijing, and Shanghai. So please see myself, see James. We can tell you more about the tour and then the 2-day conference. There's 2 separate things. As well as LendIt Europe, which is going to be in October in London. So if anyone's interested in knowing more about the London event, the China event, please let us know. Again, my name is Todd Anderson with LendIt. Thanks again for Matt, and I'll turn it over to Matt, who's going to introduce the panel, and he'll speak about alternative investing. Thank you.
Thanks, Todd. Wanted to thank the LendIt team for being super supportive of these meetups. As they've grown, it's been more and more complicated to put them all together, and they've been a great co-sponsor. And at this point, I think I've been to enough of them that if you haven't been to a LendIt China or Europe, it is worth your time. We tend to think about what's going on within our spaces on just our home countries, but Fintech and online lending is happening all over the world, and so it's really interesting to see how different markets are growing, and specifically China. Every time I go back, it kind of blows me away, so I highly recommend that piece. Before we jump into some of the questions, I wanted to give a chance for each of the panelists to give a short intro on that side. So let's see, I have Kevin, we'll start out from StreetShares, and then move on to Brian and Aaron. Oh, sure. Already messed it up. Go ahead.
Hey everybody, I'm Kevin Shane from Sharestates. I run capital markets and do quite a bit of other things there. I've been there since, for the most part, since the beginning. Prior to that, to Sharestates, I was in the gamification world, doing some really fun stuff there. But prior to that, which is why I'm here, I was at Lending Club. So I was very early on at Lending Club and learned about marketplace lending from what was kind of the beginning of marketplace lending. So really wanted to get back into it. Real estate was obviously a very interesting place if you're not already aware of what's going on in that space, and Sharestates was a good match for me, and we've just been crushing it, so passing on.
Hey, I'm Brian Bursick. I'm CEO of Wunder Capital. We're a lending marketplace connecting businesses that want to put solar panels on their roofs or on their facilities with the capital markets, individuals and institutions that want to fund those loans. A little bit about me, started at Bain & Company, started on the consulting side, moved to private equity, did a bunch of VC in this space, so backed Wunder Capital, now a publicly traded company in their Series A, with their Series A investment. So watched kind of this commercial lending industry grow up, and we're now bringing it to the solar industry in a way that we think is exciting.
Hi everybody, Aaron Kellner. I'm a principal at SeedInvest. Going to be a little bit of an outlier this evening. SeedInvest is an early stage fund and investment platform that sources, vets, invests in, and facilitates investments into typically early stage technology enabled companies, including such wonderful companies as Sharestates, one of our favorites to date.
Thank you.
And my life before, so at SeedInvest I was the company's first full-time employee on the business side, 4th employee, pushing up about 30 now. My life before SeedInvest, I worked at Goldman Sachs for a number of years, and before that in small cap private equity while getting a degree at Stern. So not a marketplace lending background, but a financy one.
Thanks. And so we'll kind of jump right into it. One of the things I wanted to start out with was this meetup group was originally called the Peer-to-Peer Lending Meetup Group when it was all retail investors. That's obviously changed significantly as institutional investors have kind of stormed into the space and take up a lot of the flows now. But wanted to give a chance for each of you to talk about what types of investors do you work with, how do they get access to the product, and how is that evolution kind of changing over time? So we'll start out with Kevin.
Sure. So I'll give a little bit of background on what Sharestates was because I kind of missed out on that. Sharestates is a real estate lender. So we're originating short-term loans for anything from residential to multifamily to mixed use, all non-owner occupied, commercial included. So what we've done in terms of, it's interesting, like you mentioned about how it used to be a peer-to-peer space. Sharestates was originally conceptualized as a peer-to-peer, but the idea was going to be peer-to-peer. So really just selling loans to everyone. We actually started off with a Regulation A. If you're familiar with that term, opened a public investment, basically open to everyone to invest as little as $100. It was very difficult to grow that. So we sort of somewhat pivoted into accredited investor only, but also institutional investor. And the institutional side, what it did was really allowed us to grow our business and to become a real business. We actually have been cash flow positive and profitable since August of 2015 minus 1 month. But it allowed us to get to that point where it then gave the confidence and trust to the individual investors to also come in and start investing in our loans. Was there another part of that question there, or?
Well, I'll have a follow-up.
Okay. We'll keep passing it on.
Yeah, I think it's a really interesting question because first of all, I think it's worth observing what P2P did and the problem it solves. And it's easy to remember now that, or it's easy to think now that people giving 10 to 20 to 50 grand to a new marketplace lender, a new financing product, or a new way of thinking about evaluating risk is normal. But before Lending Club and Prosper made that normal in 2006, 2007, if you thought you had an opportunity to deploy capital in a way that had outsized returns, there was an inefficiency you could exploit, you basically had to either be spun out of a large financial institution or you had to have a very rich personal network, because otherwise you weren't getting through the $0 to $20 million AUM and track record that got you to the first rung of the ladder on institutional capital. And so what retail really did, what P2P did, was it said, if you want to innovate in this space, it's not only financial services players spun out of Goldman, right? It's not only people who grew up with money. Anyone who has a good idea about how to deploy capital can go do it. Because now if you build a good site and you do it the right way, you can go get your first 20 million from people, right? So first, let's just recognize that I think that's super interesting. The question ends up being, once you get past that 20 million and you can have institutional capital, how interesting is the retail money? And I think for a long time, the perception was not interesting at all, right? The costs associated with bringing on $1,000 are similar to the costs associated with bringing on $100,000, right? And so you're constantly pushed up by the economics to larger and larger check sizes. What I think we saw through the financial crisis, though, was sometimes the institutional capital markets go away, sometimes segments of it are illiquid, and having diversification across both retail investors, real retail, 10 to 20 to $50,000 investments, up to the mid-markets, the broker-dealer space, right, the high net worths, the small family offices, 6-figure, 7-figure checks, up to big institutions. I think, to me, that's where it's exciting once you get through that first chicken and egg problem, right? How do you get your first 20 million? Even after that, what we're seeing is the strategic players that are thinking about backing our company, not our marketplace, see retail investors as a way that if the institutional capital market shut down, you can keep going on, right? So that's my take on P2P.
Slightly shorter answer.
Sorry, I rambled.
So we basically offer a range of offering exemptions for the issuers with whom we work. While there are certain issuers or certain offerings that are available only to accredited investors, the majority of offerings on our platform are available to everybody. As it stands today, our investor network stands at about 160,000 people, 20 to 25,000 of which are ultra-high net worth individuals, family offices, VCs, corporate venture arms, and so on and so forth. And as it stands today, we've facilitated individual investments as little as $100, with the largest individual checks written through our platform at about $2 million.
And so a follow-up question there, what would you say is the breakdown of mix between those family offices, quasi-institutional investors on your platform, and the true retail that is investing less than $10,000?
I would say around in the bucket of 2,500 to 5,000 are going to be in that camp of if they're cutting a check, it's going to be at least 50 or 100K, and the remainder are going to be, even if they're wealthy individuals, people not looking to commit more than 5K per opportunity. Obviously, again, with what we're doing being such a riskier, more illiquid asset class that doesn't, guarantee any type of return, let alone, regular yield, that people do tend to be a little bit more risk off relative to, a pure marketplace lending platform.
And Brian, what do you think that optimal mix is? And you can say in practice, today, theoretical.
Yeah, sure. Today in our marketplace, it's pretty much 50-50 between what we call retail investors. That's anyone below 100,000 for us and above 100,000. I think as a mature marketplace, if you had a third, I mean, I know that's just an easy answer, but seems to me as though you'd feel relatively diversified against whatever threw itself at the market.
Kevin?
Sure. Currently, we're somewhere around 90% institutional, 10% individual, accredited individual. Ideally, we'd like to build up that accredited individual, but it's just so expensive to get to that person. But I would say 70-30 would be a very healthy ratio for us. And for a few reasons. I think the retail, the individual brings a stickier sense of capital. You're obviously well diversified. And then it can help with valuation of your company, I believe, if you have more users on your platform. So.
And switching topics a little bit, one of kind of the complaints that I hear a lot from fintech companies is there's a lot of finance and there's no tech. So I wanted to make sure we touched on it today. How does technology play a role in your companies, and how are you seeing that change over time? And is it really a moat in your business, in your view, and when you're thinking about that? Happy to start on either end.
So one thing that I would say actually is most concerning for us, again, through the lens of the space in which we operate, is we're actually seeing a lot more tech and a whole lot less finance, in that a lot of platforms that are in a space similar to us are founded by, kind of tech guys, or, kind of people who want to feel like they're making more impact type investments, where the goal of everything they're doing is to make a really smooth process for capital raising without any type of regard as to whether or not the investments that they're facilitating should be being made in the first place. It's one of the things that makes us a bit different than almost anybody else that does what we do, in that we do conduct our own independent multi-tiered due diligence on every offering before potentially making it available for investment. Over the last 4 years, we've had now in excess of 10,000 companies that have applied to work with us, of which we've accepted 1.3%. So we're extremely selective in terms of who we work with, in terms of the valuations they're raising at, how deals are structured, the uses of capital, securities being offered, the individuals backing the company, so on and so forth. And that's actually not a very common practice, at least in our area. And that's, our favorite question to entrepreneurs that we also like being asked ourselves is, what keeps you up at night? And that's what keeps us up at night. To answer your question a little bit more head on in terms of how technology plays a role, I mean, it really is what is the backbone of streamlining every aspect of our operations. I've been speaking just in terms of a very recent example with a $500 billion asset management company that approached us because their private wealth group is looking for solutions to be able to get their clients into later stage deals that they have allocations in. And they're basically trying to figure out whether or not there's a way for them to be able to do that profitably if they're only putting, let's say, $5 to $10 million into a deal. We can profitably conduct a raise as little as $100,000. So, and that's all in terms of things like every type of ID verification, anti-money laundering procedures, basically every type of obligation that we have as a broker-dealer being automated directly through our platform.
In energy finance, it is the opposite. There are not a lot of technologists, there are a lot of finance folks, right? And Matt and I were talking about this before we started. We'll go pitch VCs and talk about technology, and they'll ask about machine learning and AI. And we have great technologists, but that is not the level of technology you need to rise to in financing to be the best technologist. It's more like don't use Google Sheets or Excel models. What technology enables for us is most specialty lenders in our space can't go below about $1 million financing size because they make 2 to 3%, and that's more than they cost them to do the deal. So technology is what enables us to focus on the sub-$1 million market because our fixed costs are a lot lower. That said, you asked about competitive barriers. I think anyone who's using technology or thinks technology is a competitive barrier is a fool. Technology is something that you can purchase. It's hard to purchase, it's hard to manage, but the idea that the entire marketplace would watch you kick off cash flow and not invest in technology is crazy. And so I think you have to have a second story about competitive differentiation above and beyond technology, even if your space is like mine, in which the people trying to layer on technology to their business are quite bad at it. Someone will come after us at some point that's a raw technologist.
And so what is that second layer of your moat? Is it data? Is it expertise? Is it people?
Right. I mean, I think for any marketplace lender, the idea is to get to the point at which if your space was underpenetrated, you have more data about that space than anyone else, right? There's some first mover advantage that I'm deeply skeptical of first mover advantage. I think the study of history suggests it's not that valuable. There are some businesses in which I believe, for example, the first person to put $500 million into commercial solar financing will be the market leader because they'll be able to go to Wall Street and say, I'm the only person who's put $500 million into that market. I'm the only person who has that data. I'm the only person who does that feedback. And so ultimately, yes, you get to these data network effect sort of things, but you have to get quite far in technology, I think, before you get to those sorts of dynamics with our sorts of models.
And my answer is very much in line with Brian, except we've got actually this question asked to us quite often is, how does technology make your business better? And we start off that answer with a premise of saying, well, we're real estate people. Our company was founded by 3 individuals. 2 of them had known the real estate market in New York better than many. And from there, we built on the expertise necessary to compete in this space. Technology comes in to make our business obviously much more efficient and scalable to help with our growth over time. It's used in every single department of our business, but I have to say it's also not as important in 2 specific areas of our business, which are the origination channel. We use it to make origination more efficient, but to actually go out there and get the borrowers and the projects that we're lending on, it's used quite less in that. It's very much a boots on the ground kind of a business. And then the second is underwriting. The way we use underwriting is to get rid of the bad loans. And then we use a much more manual process to approve the good loans. So, but like I said, technology definitely plays a major role in a lot, but we're real estate first, financial and tech second in that order.
And a follow-up question on that is, when you're explaining to an investor, like how this product that you're originating fits into their portfolio, how do you go about that? Whether it's, it could be different for different types of investors, but how do you think about the real estate assets that you're originating? Where does it fit into a portfolio mix?
So I've actually been able to, since I've been with the company for quite some time, I've had a role in many different parts of the business. One of them is working with a lot of our investors. So my answer really is coming from what they like about our product and what I've heard that they like about our product and why they continue to reinvest in our product. And there's really 5 things that I like to think about that come to mind when they're telling us what they like about it. And number one is that it's collateralized. Every loan that we originate is collateralized by the property itself. Mostly senior position loans. We've done a few mezzanine, but it's 95% senior loans, senior liens. And they also come with personal guarantees. Another aspect is they're cash flowing, they're monthly cash flowing, so every month as the borrower is due an interest payment, once we receive that interest payment, we're distributing that interest back to our investors. A third one would be the returns. We actually haven't put anything on our platform under 10% net return to the investor. That's on the individual investor side. Institutional is quite different because we also do sell whole loans, but when we sell fractional pieces of loans, nothing's been below 10%. Our track record, we've originated over $400 million in loans to date across about 500 loans, 0 losses. Of course, we've gone through defaults and we've had a foreclosure, but they will still not equate to a loss at all to the investor. And then the fifth, I believe, is also what I've heard is just that we're institutionally vetted. So when we, as I mentioned at the very beginning, many of our, the reason that I believe we've had a successful retail platform is because we've had institutional investors on there. And that's for a few different reasons. One is they vetted our company, the company itself. They've gone through everything from the compliance aspect of it, from the tech side to the compliance of the actual lending side as well, and every aspect that you could think of. They've vetted our team, the team members are themselves, and with the way we fund our loans is that we pre-fund our loans for our individual investors, and we wouldn't be able to do that if we didn't have institutional capital, and that allows our borrowers to get their capital very quickly, so we can close loans in 10 days, but also allows for our individual investors to invest and not have any cash drag. So when they're investing in an accruing product already. But those are really coming more from the investor themselves that I've heard on my side, just working on it with individual investors and institutional.
Yeah, so we have two archetypes. One is folks who have a fixed income or bond portfolio, or they're looking for a consistent yield, and 8.5%, which is our largest fund, delivers 8.5%, and that's appealing in that context is what we've seen. It's also an asset-backed security, so similarly we have collateralized loans. The other group for us, being in solar, is impact. So what we've seen is that for a lot of, particularly family offices, we've seen, there's someone in that family or someone in that advisory group that really wants to take a portion of that portfolio and do something positive above and beyond the returns. But there's someone else on that committee or in that group who really needs to see market returns. They're not willing to give money to a conservancy fund that promises you 2 or 3% to buy grasslands. So we often find ourselves making the market return person happy while also gratifying the impact person. And so a lot of what we see working for Wunder is living in between that justifiable purely on the economics, but also really good impact.
So for us, again, it's going to depend on the investor, and there's a high degree of variability between them. I think, starting with the fluffier things, one is that, you're kind of getting in on sexy young technology companies. You want to invest in a drone company, a robotics company, an artificial intelligence company. That's the type of stuff that we offer. That's the type of stuff, especially kind of in a pure play way. Yeah, like there are certain publicly traded securities where you could kind of make an argument for exposure to the IoT space and so on and so forth. You can go that strategy. But if you want pure play exposure to essentially emerging technologies, that's the type of product that we offer. Given the stage at which we work with companies, there is also an element of, especially among the more sophisticated investors in our network, whether they are just ultra high net worth individuals or literally institutions of being able to quite literally make an impact on the growth of a company. We source board seats, we source formal advisors, and the reality is that for any young company, the more people that you have in your camp, the more people that have a financial interest in the success of your business, the better. And it kind of grows the network and grows the resources of the companies that we work with. And the flip side for investors is having the ability to do that. One of our a former head of digital that actually used to work at one of the two leading platforms in England, a company called Cedars, would document that by far their most active investor over there was just this lawyer who would kind of log on almost a daily basis, see what kind of tickled his fancy, and throw a few £100 into it. One, because it kind of looked like he was doing work while he was at work, even though he wasn't doing work, and also kind of for that that emotion and that feeling. Reality is as well is that the early stage asset class in specific, provided that you've achieved a proper level of diversification over the last 30 years, has grossly outperformed both stocks and bonds. So there is an actual return argument to be made as well for the asset class, as well as the fact that it's also just not as highly correlated. You can make an argument that it's completely uncorrelated to the public market. So while the especially early stage VC should comprise a very, very small percentage of one's overall portfolio, that it can actually serve as a overall de-risking mechanism as well.
And then I always like to kind of end these with a vision of the future. So anyone who's been following Fintech, we've had equity crowdfunding with its moment, we've had lending with its moments, the press has built up both and tried to rip down both. Now currently, if you have insurance in your pitch deck, you get funded instantly. What do you see as kind of an active participant within Fintech throughout kind of the rest of this year as a forward-looking statement?
Real estate. I don't speculate. I really don't speculate. I do read a lot of the news, but I really don't speculate. I'm bullish on real estate. I was bullish on real estate before I joined the company because I was going to events like Orchard events and LendIt events and other conferences. I saw that real estate was hot, and a lot of the institutional capital has been moving over to real estate because it's collateralized. The returns are there, so I just can't speak too much outside of real estate, sorry. But I'm also very bullish on it.
Yeah, I guess two high-level observations, one about fintech and one about MySpace lending. First of all, when technology started, Mark Andreessen has this kind of famous quote, "Software's eating the world," kind of correlated to that, but not at the same rate, right? And when we got started as a technology industry eating the profits of fintech was taking 26% of the profits in the GDP. That's insane, right? That's a big ass profit pie just waiting to get eaten by a bunch of hungry software entrepreneurs, right? And it's also crazy to think that a quarter of the profits in an economy would be from people transitioning capital from people who have it to people who need it. Like, that's not a quarter of profits in any reasonable economy. So I do think that you should expect to continue to see technology really undercutting some of the profit pies, profit pools, right, inside of technology. I can tell you I was down at Structured Finance in Vegas 3 months ago, and the number of, bros getting drunk during the day that clearly make a lot of money trading CMBS that takes a monkey to trade, like, that market hasn't been eaten yet. I hope there's someone sitting up here soon undercutting their jobs, right? And so I do think we should expect this to be a secular revolution, not a cyclical revolution. And if you're sitting somewhere where a bunch of people are making 350 grand, not creating a lot of value, expect that to stop. The other thing I'll say about lending, because I'm in the lending space, is that the big challenge in lending has been customer acquisition costs. That's no big surprise to anyone. Lending Club and Prosper came into all of this 22% credit card debt, flipped it down to 10 to 12% P2P debt. That's a great trade. There was a bunch of it sitting out there. That's kind of gone away, right? And I think, and I'm biased here, but I think point of sale lenders, people that have, whether it's auto sales, it's HVAC, whatever it is, if there's a borrowing opportunity created by virtue of the engagement, right? Whether, for us, it's a business interested in going solar. At that very moment, they need $500,000 at that moment. Being sitting there as dealer track and auto, or HVAC installation, whatever it might be, being there where the borrower demand is being created, I think is the future of the lending marketplace, because that solves the big challenge that lending marketplaces have faced. So I don't know if that's this year, but that's my take on that.
Super high level, I echo the thoughts regarding continued disintermediation. Also, I'm not going to contain this within the next year because it is going to be a longer trend, but again, in our space, I do foresee a continued disintermediation of the traditional players in early stage investing and capital raising, specifically among venture capital firms, even in terms of the evolution of equity crowdfunding. What we've seen to date, the security laws that have essentially enabled everything that we're doing, for those of you who don't know, is a piece of legislation known as the Jobs Act, which was actually signed into law in 2012, didn't fully come online until last year. When that legislation was being, kind of debated in Congress, I mean, kind of the status quo of, not just venture capital firms, but even just angel groups was, this is absolutely ridiculous. There is no way in hell this is ever actually going to get passed. Then it became increasingly clear that this was going to get passed. It actually passed the House on a vote of 407 to 17, so it was probably one of the singularly most supported piece of legislation probably in the last 15 years. It was going to become law, and basically the status quo kind of consensus among the standard industry players was, well, okay, fine, this is going to become law. There's absolutely no way anybody's actually going to invest online into early stage companies through a platform. And what we've increasingly seen over time is that now the stance is, okay, well, this is clearly happening. This is honestly starting even a year or two ago. How do we actually interact with this now? The Angel Capital Association, for example, is an organization that we have been engaged with for probably 3-4 years already at this point. And again, around the time that legislation was signing, we asked about a potential membership to join, and were basically laughed away by the leaders of the ACA. And within a year of the legislation actually coming online and being signed into law, we were one of the first 2 platforms that were accepted, because what the Angel Capital Association saw was with their investors and the groups, saw their members and their investors basically just fleeing these groups because they're inefficient, they're not getting access to widespread deal flow, there's a lot of kind of like infighting that happens there, and people kind of just wanted to make their own decisions. I think that while not to the same extent, what we're seeing in terms of the actual value, for example, that hedge funds provide to their LPs is going to be kind of turned to venture capital firms as well. There are a lot of good companies out there that are not venture capital worthy. There are a lot of venture capital firms that don't actually provide really good returns for their LPs, and honestly don't add a lot of value for the issuers themselves. It's actually a common conversation that we're having, or an increasingly common, conversation that we're having with issuers, especially repeat entrepreneurs, saying, if you're telling me that there is a way that I can raise money for my business and not take a check from a venture capital firm, sign me up. I will literally do whatever I can to not take money from a VC. So again, the top tier are the ones that actually add value, the ones that we all know and love, the Andreessens, the RREs, so on and so forth. They're not going anywhere, but there are so many that are out there that really don't do anything. And I think that empowering companies to be able to raise from everybody, from their own customers, and realize the benefits that entails, and that's kind of the newest thing that we're doing now, is actually going to start to prove some inflection points in terms of a company's ability to accelerate quite quickly.
Well, please join me in thanking the panelists for a great discussion.